Let me describe two people to you. Same city, same age, both 34, same income, same apartment complex, one floor apart. They passed each other in the parking lot every morning, both drinking the same too expensive coffee, both watching the market wobble in early 2020 thinking this is probably fine. It was not fine. The market dropped 34% in 33 days. Here's where their stories split. Person A had no emergency fund, $11,000 in credit card debt, and a 401k that was 90% tech stocks. He got furloughed, panic sold everything, locked in a $40,000 loss, and never went back. He's $180,000 behind where he'd be if he'd done nothing. Person B kept contributing through the crash, used the drop to do a Roth conversion, came out with more shares at lower prices. The crash didn't create that gap. Everything they did in the months before it hit did. My name is Nick, and I've spent way too much time studying why some people build wealth through crashes while others get destroyed. That's what we're covering today. Before we get into what to do, let's make sure we're all looking at the same market, because right now the warning signs are louder than they've been in a very long time. And I want to explain why without making you feel like the world is ending, because it isn't. Here's where we actually stand. The Shiller-Cape ratio, one of the best long-term valuation measures we have, is currently in the high 30s. The long-term average is around 17. We are still well above historical norms. The last time we saw levels like this was during the dot-com era in the early 2000s. Right before the Nasdaq lost nearly 80% of its value and the S&P 500 spent years recovering. Great company, great timing. On top of that, the top 10 stocks in the S&P 500 now make up roughly 30% to 35% of the entire index, depending on the exact date. 7 companies, Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla, account for roughly a quarter to around 30% of the index today. During the dot-com peak, that concentration was closer to 23%. We've moved well beyond that level, and in 2022, those same large cap tech names fell sharply, while the broader S&P 500 declined less, showing how concentration can distort what diversification really means. The index looks diversified. It isn't. Then there's the geopolitical volatility in the Middle East and the Strait of Hormuz, the narrow channel that carries roughly 20% to 25% of global seaborne oil shipments. With energy prices remaining volatile, core inflation still stubbornly above central bank targets, and major banks keeping recession probabilities elevated, the red flags are everywhere. Consumer confidence is currently weak by historical standards. While declines in confidence have often occurred before recessions, there is no fixed threshold like 80 that reliably predicts economic downturns. And then there's Warren Buffett, with Berkshire Hathaway holding hundreds of billions in cash and short-term US Treasury bills. He's been a net seller of stocks in recent periods. Berkshire Hathaway is currently outperforming the broader market, and he isn't doing this because he's afraid of missing upside. He's doing it because he's done the math. Now, and this is important, none of that means a crash is definitely coming or that you should sell everything. What it means is that the conditions that have preceded every major market correction in modern history are currently present. And if you haven't done the 5 things we're about to cover, you are person A in that opening story. Not because you did something wrong, because nobody ever sat you down and explained how this actually works. Let me introduce you to a couple we'll call Arkin and Via. He's in project management making $58,000. She's in healthcare admin at $54,000. Combined household income, $112,000. That puts them in the top 30% of American households. They should be building something. Instead, they have $4,200 in savings, $14,000 in credit card debt at 21% APR, a 401k that Arkin hasn't looked at since he enrolled, sitting in the default fund, 65% concentrated in US large cap growth stocks. They have no idea. When COVID hit in February 2020, Arkin got furloughed for 6 weeks. The market dropped 34%. Their savings ran out in 3 weeks. They started pulling from Arkin's 401k, which triggered a 10% early withdrawal penalty on top of ordinary income tax, meaning they lost roughly 30 cents of every dollar before they even saw it. They sold the rest in mid-March, right at the bottom, because the news was terrifying and they needed the money. The S&P 500 recovered to its pre-crash high by August 2020, 5 months. Arkin and Via missed the entire recovery because they weren't in it. When Arkin re-enrolled 6 months later, he set his contribution back to 3% because money was tight. By the end of 2021, the S&P 500 was up 114% from its March 2020 bottom. Arkin and Via captured zero of it. Congratulations, Arkin. Impeccable timing. I'm not telling you this to make Arkin and Via feel bad. They're not irresponsible people. They did what felt rational under pressure with no emergency cushion, no plan, and no framework. But here's the brutal truth. They lost approximately $60,000 to $80,000 in potential account value through that sequence of decisions. Not because the crash was worse for them, because they were financially exposed when it hit. Everything I'm about to walk you through is specifically designed so that you are not Arkin and Via. Here's the truth about emergency funds that most people don't want to hear. The emergency fund is not a boring beginner tip. It is the single piece of infrastructure that determines whether a market crash destroys you or barely affects you. If the market drops 40% and you have 6 months of expenses in cash, the drop is just a number on your screen. You wait, you keep contributing. The crash is working for you. If you have $800 in savings, the drop is a timer. The moment any unexpected expense appears, and they always do, you're forced to sell investments at the worst possible price. Exactly like Arkin and Via push for 6 months. If your monthly expenses run $4,500, you need $27,000 in accessible cash. The median savings account in America holds about $8,000. So most people aren't a little short. They're in a completely different zip code from where they need to be. And that gap is exactly why crashes disproportionately destroy the people who can least afford to be destroyed. The good news, that cash doesn't have to sit idle. High yield savings accounts are paying 4.0% to 5.0% APY right now. Not the 0.01% your big bank has been quietly offering while lending your money out at 22%. Build the cushion, put it somewhere it earns something. That's the entire move. I want to ask you something. If someone walked up to you right now and said, I have a guaranteed, completely risk-free investment returning 22% every single year, what would you do? You would obviously say yes. You throw every dollar you had at it. Paying off a credit card at 22% APR is that investment. A guaranteed, risk-free 22% return on every dollar you put toward it. The S&P 500 has returned about 10% annually over the long run. Your credit card is quietly beating it, just in the wrong direction. Americans are carrying over $1.3 trillion in credit card debt right now. According to Federal Reserve data, that's a record high. When you combine record high interest debt with limited emergency savings, the math for a market crash is not good. Roughly 40 to 50% of Americans say they would struggle to cover a $1,000 emergency from savings, depending on the survey. A country carrying record high interest debt with limited emergency savings heading into an uncertain market. The math on that is not good. The framework is simple. 6% is the threshold. Any debt above 6% gets paid off before you make additional investments. Above that rate, the guaranteed return of eliminating the debt beats the expected return of investing. Below it, investing wins. The one exception, always contribute enough to your 401k to capture the full employer match first. That's an instant 50 to 100% return before the money even touches the market. Nothing competes with that. Capture it, then attack the debt from highest interest rate to lowest. When is the last time you actually looked at your 401k allocation? Not the balance. The actual breakdown of what percentage is sitting in what. If the answer is when I enrolled or I'm not totally sure, you are not alone, but you might be sitting on a concentration problem you don't know you have. Here's the thing about S&P 500 index funds that most people don't fully appreciate. When you buy a standard market cap weighted S&P 500 fund, you are not buying 500 equal slices of the American economy. You are buying a fund where Apple alone is 6% of your portfolio, where 7 companies are 30% of your total holdings, where the actual number of companies meaningfully driving your returns is somewhere around 44 to 54 stocks out of 503 total, and that concentration is near the highest in 35 years of data. In 2022, those 7 companies fell 41%, while the broader index fell 19%. When concentration unwinds, it doesn't do it gently. Look at your allocation and make sure it reflects your age and timeline, and more importantly, how much volatility you can genuinely stomach without panic selling. Because the number that matters isn't your risk tolerance on paper. It's your risk tolerance at 11 p.m. when your account is down $40,000 and every financial headline is using the word collapse. A rough starting point, subtract your age from 110. That's your ballpark equity percentage. If you're 35, roughly 75% equities. If you're 50, closer to 60%. To reduce tech concentration without abandoning index investing, look at equal weight S&P 500 ETFs. Same 500 companies, but Apple and a mid-size industrial company get the same 0.2% weighting instead of Apple eating up 6%. During the 4 worst S&P 500 drawdowns from 1994 to 2020, consumer staples averaged a positive 26% return, utilities positive 15%, healthcare positive 16%, while the broader market averaged negative 40%. You're not trying to predict the crash. You're just making sure not every egg is in the most breakable basket. I need to say something that is going to feel completely wrong, and I need you to stick with me before your gut overrides the math. When the market drops 30% and your account looks like it got hit by a bus, every instinct in your body will tell you to stop contributing, to pause, to wait until things stabilize. Do not do this. Here's what's actually happening when the market drops. Every share of every fund you own just went on sale. The market is the only store in the world where people run for the exits when prices fall. JP Morgan ran the numbers on missing just the 10 best trading days over a 20-year period. 10 days out of 7,300. Stay fully invested from 2004 to 2023 and $10,000 becomes $72,000. Miss those 10 days, $35,000. Miss 30 days, $13,000. And 78% of the market's best days happen either during a bear market or in the very first days of the recovery. If you're in cash waiting for things to feel safe, you miss them entirely. Now, you might be thinking, Nick, what if this time actually is different? And I want to give you an honest answer. Since 1928, there have been 28 bear markets. Average decline, 35%. Average recovery time, about 2 years through the Great Depression, World War II, 2008, and COVID. Every single time, the people who stayed invested recovered. The only people who lost everything were the ones who sold at the bottom and made their losses permanent. That's not a guarantee. But it's 100 years of consistent data, and it is the best information we have. The 2026 401k limit is $24,000. If you're 50 or older, it's $31,500. And if you are between 60 and 63, there is a special super catch-up provision that allows you to contribute roughly $35,250, depending on final inflation adjustments. Keep the contributions running by the drop. Future, you will be grateful. Almost nobody talks about this when markets drop. And it's one of the most powerful moves available to a regular person. A down market is the best time to contribute to or convert to a Roth IRA. When you contribute to a Roth, you pay taxes now on the money going in. Everything that grows from that point forward, every recovery gain, every dividend, every dollar of compounding over the next 30 years comes out in retirement with zero tax. Not tax deferred, tax free. And if you're contributing during a downturn, you're paying tax on a smaller number while locking in tax-free growth on the entire recovery. Even better is the Roth conversion. Say you have $150,000 in a traditional IRA and it drops to $100,000 during a crash. If you convert to a Roth right now, you pay income tax on $100,000, not $150,000. You just saved yourself taxes on $50,000 worth of value that you'll fully recover, and all of that recovery happens inside the Roth, permanently tax-free. You got a $50,000 discount on your future tax bill because you acted when the market was down instead of waiting. The 2026 Roth IRA contribution limit is $7,500 if you're under 50 and $8,500 if you're 50 or older. Income limits apply. Single filers phase out between $153,000 and $168,000, and those married filing jointly phase out between $241,000 and $251,000. Above those limits, look into the backdoor Roth. Still legal, still works at any income. All right, we've covered the financial mechanics, and honestly, the mechanics are the easy part. The hard part is what happens inside your head when the market is down 25%. The news is genuinely frightening, and every instinct you have is screaming at you to do something. So let me give you permission to do something radical. Ignore every market headline for the next 6 months. Not because the headlines are wrong, because they are structurally, commercially, and algorithmically designed to make you feel like you need to act right now. Financial media makes money when you click, when you panic, when you trade. Your 401k makes money when you sit still and stay consistent. Those incentives are not aligned. They are not even in the same building. And once you genuinely understand that, you can stop treating CNBC as a financial advisor and start treating it as what it actually is, entertainment dressed up in charts. Here's the specific psychological mechanism that causes otherwise rational people to blow up their finances during downturns. Nobel laureate Daniel Kahneman found that losses feel roughly 2.25 times more painful than equivalent gains feel good. A $10,000 loss causes more than twice the psychological pain of a $10,000 gain. This is not a personality flaw. It is hardwired into the human brain. You cannot think your way out of it in the moment. You can only prepare for it in advance. The AAII Investor Sentiment Survey has tracked investor mood since the 1980s at the exact bottom of the 2009 crash, the single best buying opportunity in a generation. Bearish sentiment hit an all-time record of 70.3%. Maximum pessimism at the moment of maximum opportunity. The S&P 500 gained over 400% from that point. Meanwhile, bullish sentiment peaked at 75% in January 2000, right before the dot-com collapse wiped 49% off the market. Maximum confidence right before the disaster. Maximum pessimism right at the bottom every single time. An MIT study found that 30.9% of investors who panic sold during a downturn never returned to the market. Never. They locked in the loss and left the table permanently. That's not a strategy. That's a ghost story for personal finance people. Dalbar's data says these behavioral mistakes cost the average investor roughly $1 million in lifetime wealth. Not from bad stocks, not from high fees, from being human at the wrong moment. So here's what you do about it. Make the decision now, before you're inside the moment. Write down your plan. Commit to it in advance. Decide today, not during a 3 a.m. news alert when your account is down $50,000, that you will not sell your long-term investments during a crash. Your emotional state during a 30% drawdown is the single worst financial advisor you could consult. Let me just say it plainly. If a crash comes, and I'm not going to tell you when because nobody knows when, the people who come out ahead will not be the ones who predicted it. They will not be the ones who sold at the top and bought at the bottom. Nobody consistently does that. Not hedge fund managers, not Wall Street strategists, nobody. The people who come out ahead will be the ones who did 5 specific things before it happened. Built the cash cushion, killed the high interest debt, rebalanced the portfolio, kept investing through the drop, and used the tax advantages a down market creates. Not one of those things requires predicting when the crash happens or how far it falls. Person A from the opening story didn't lose because the crash was worse for him. He lost because he walked into it financially exposed and emotionally unprepared. Person B didn't win because she got lucky or saw it coming. She won because she had done her homework before the crisis arrived. Arkin and Via didn't lose because they were bad with money. They lost because nobody ever gave them a framework before the moment they needed one. Every crash in modern history has been followed by a recovery. The investors who got destroyed weren't destroyed by the crash. They were destroyed by what they did during it. And what they did during it was determined entirely by what they had or hadn't built before it. If you're watching this right now and you're feeling behind, no emergency fund, more debt than you'd like, a 401k you haven't looked at in 2 years, I want you to hear something. You're not behind because you're bad with money. You're behind because nobody ever sat you down and explained how any of this actually works. The financial system is extraordinarily good at making money feel complicated enough that you believe you need to pay someone else to understand it. You don't. The playbook is simple. 6 months of expenses in a high yield account earning 4 to 5%. Every dollar of high interest debt above 6% eliminated before it compounds further. A portfolio that actually reflects your age and your timeline, not whatever you were defaulted into at enrollment. 401k contributions that run continuously, especially during downturns, and a Roth IRA being used as the tax weapon it was designed to be. The crash, if it comes, is not the end of your story. For the person who's prepared, it's the beginning of the best chapter. Warren Buffett has built a historically large cash position at Berkshire Hathaway, sitting on hundreds of billions in cash and treasury bills, and he didn't build that pile by panicking. He built it by being ready. You can be ready too.